Hey everyone, Terrace here. Okay, today we're going to talk about Real Estate 101. If you have never bought a home, if you don't know what it looks like to buy a home, if you don't know what mortgages are or what it takes to get a home loan, today we're going to talk about all of that. I'm going to do a very macro overview on what that looks like and what you should do in order to get your first home, how to look at real estate, and just a basic real estate 101 on mortgages. Now, if you like the content in this channel, please like and subscribe. It helps me out. It helps the channel grow. And I'm doing whatever I can to grow the channel, of course, to add more value to you and your family and the market. Real Estate 101, let's say you're out and you're like, okay, I think it makes sense for me to buy a home. Well, the number one question I would ask is why? Why do you want to purchase? And majority of people are going to say, well, I'd rather pay myself than go pay, a landlord or go pay this apartment complex to rent, which totally makes sense, right? You want to pay yourself. You're able to build financial wealth, which is huge, which is a great decision to make, I want to say. I mean, if you're thinking about it right now, you're already on the right path. Real estate is the number one wealth building tool out there. Now, what does it take to get a home loan? What do you do? How do you start? So step one is really to analyze your budget. Now, what is a lender going to do? How do you get approved for a home loan? How do you analyze your budget? What can I afford? So the number one thing to think about is, okay, what do I spend every single month, excluding my rent, right? So you're going to go over what your survival number looks like every single month, what you spend, and you get that number to a T. Right, because remember, you're going to have a mortgage. Your mortgage payment's probably going to be a bit more than your rent payments, but that's a fixed payment for 30 years versus having something like rent that goes up every single year, plus minus, I want to say plus 10, 20%. Maybe it goes down 5% here or there, but your rent's going to continue to increase versus your mortgage. Your mortgage is fixed. So, okay, you got your budget down. You're like, all right, this is what I spend every single month. Phase number two, and a question that I ask a lot of my clients is, okay, what's a comfortable monthly mortgage payment, right? Like what's something that you'd be comfortable to pay on top of your expenses, on top of all your bills? Do you have any major debts that you need to focus on paying off prior to getting a home loan? And you want to go over that. So once you have that number dialed into a T, let's say that number, hypothetically speaking, is, let's say $3,000. On $3,000 a month, what you need to know on a mortgage, from a mortgage standpoint, is in order to qualify for a $3,000 a month mortgage payment, your total debt to income ratio, which really is, hey, look, this is what my mortgage payment is going to be. Let's say it's $3,000 plus any debts, minimum payments on car loans, student loans, anything that you have, credit cards. That's going to be your total debt to income, and we look at gross income. Everyone's going to look at gross income. Gross income is not what you put into your pocket. That's net. Gross is like, hey, here's a full breakdown on my pay stub, and you're going to go over, okay, including how much money you invested into 401k out of that pay stub, including all the other expenses that the company has, and you go through your full breakdown, and okay, this is your gross number. Again, net is what you take home. Gross is what really you're claiming with the IRS that you made, that gross number. Your debt to income ratio has to be at 50% or less. Majority of the time, that's a good rule of thumb to live by, is 50% or less for you to qualify for a home, which means, let's say your total expenses after everything, you have no credit cards, you have no car loans. Let's say it's $3,000 a month that you want to spend on a mortgage. That's principal, interest, taxes, insurance, everything combined, excluding utilities, right? It's going to be $3,000. You need to be making a minimum or gross a month of $6,000 a month, right? So that's just a basic rule of thumb. Now, once you have that dialed into a T and you're like, okay, I know what I'm going to spend every single month on a mortgage. That's what I'm comfortable. You'll take that number. Of course, you're going to add your bills, add what you pay already. And you're like, all right, my total number is X. Let's say it's $5,000 or $6,000. Your next step is going to be, okay, what kind of loan can I qualify for before I even go and look for a house? Because that's also going to determine what your payments look like. Debt to income ratio is a factor for one. For two is your credit score. If you have a credit score that's above 700, you're most likely going to get what's called a conventional loan. If you have a credit score that's under 700, you're most likely going to get an FHA loan, unless you're military or you've served in the military. And if you have, thank you for your service. Then you can get a VA loan with zero money down. From a conventional and FHA standpoint, you do want to try to go and get a conventional loan. That's the goal. That's the loan program that I'm on. That's the loan program that we focus on giving to all our clients. If somebody goes and gets an FHA loan, we want to refinance them out of FHA onto conventional. Well, Terrace, why? What's the reason? Like, why can't I just stick with FHA? FHA has what's called private mortgage insurance versus conventional that has basic mortgage insurance. Private mortgage insurance is stuck on your loan for the life of the loan. So a little bit about mortgages. A lot of people say you need to put 20% down. You do not have to put 20% down to get a home. You can put 3% down if you're a first-time home buyer. You can put 5% down. Now, with these smaller down payments, you're going to have mortgage insurance that you have to pay. But that mortgage insurance gets removed once you own 20% of your home, right? They call it your loan-to-value ratios, 80% or less. Fancy way of saying, look, if you have 20% down, then you're good to go and you don't have mortgage insurance. Now, that 5% down conventional loan program, yes, you'll have mortgage insurance, but that goes away after you own 20% of your home. You're making your payments on time and all that jazz. FHA, you're stuck. It's there. It's for the life of the loan. So what we do is we go, okay, when is the home going to appreciate? Because it appreciates most likely every single year. As your home appreciates, where can you be at? And then boom, then we refinance you onto a conventional. Now, let's say your credit score is fine. You're above 700, above 720. And you're like, all right, I'm ready to roll. Your next steps, really easy, you have two. Number one is to connect with a good lender that can help you get pre-approved for a home loan, help you do a total cost analysis of based off of your payments, this is how much loan you can qualify for. There's a lot of factors. Factors are going to be taxes, mortgage insurance, home insurance, basic home insurance. If you live in Florida, you're going to have flood insurance, and that's going to kick you. If you live in Washington State and you want to live on the water, you're going to have flood insurance. That's also going to kick you pretty hard. It can get pretty expensive to have flood insurance. Do you want to have hurricane insurance, or do you want to have a certain insurance policy under your home? So that also plays a role. Here in Washington State, I like to say, hey, look, if a home is worth under $500,000, you're probably going to spend around $90 to $100 a month. If it's worth more than $500,000 or $500,000, then you're probably going to spend, I don't know, $120, maybe $130, and then as that number goes up to $1 million or more, your insurance policy goes up. Because to insure a home that large or that expensive, it's going to cost you more. Also, a big factor to consider is, are you buying a house, or are you going to buy a condo or a townhome? Why? Condos and townhomes, majority of the time, 99% have HOAs. HOAs play a huge role. HOAs affect your total qualification ratios. Oftentimes you can qualify, let's say there's HOAs on a house for $500 a month, or HOA in a condo or a townhome. Oftentimes you can qualify for a $100,000 more house, or buy a condo or a townhome $100K cheaper, but your payments stay the same because the house doesn't have that HOA. So that's a really big factor to consider. Lastly, once you get all that dialed in, you know what your numbers are, you reach out to a loan officer, you get pre-approved, pre-qualified, really pre-approved for a home loan. Then afterwards, you want to connect with a really good real estate agent that's an expert in your market. My recommendation is do not go with the big online brands. Now, what does that mean? I wouldn't go Redfin. Right? I wouldn't go and get a Redfin realtor, because a Redfin realtor is not going to care so much about you versus a real estate agent that's local in that market. Well, the why behind that is the Redfin realtors, just regardless, they're going to get their salary. They're going to get their check, whether they negotiate for you or not. It's a very flat-based type of real estate agent. They're not going to negotiate for you on your behalf the best way possible. That's why I recommend work with a local realtor that is not a W-2 employee that works on commissions. As a buyer, you don't have to pay that real estate agent anything. The sellers are going to pay the real estate agent. Majority of states say, hey, look, sellers are going to cover both real estate agents' commission checks. So find a really good real estate agent that knows what they're doing, that's good in the market, and that will negotiate for you like a shark. You do not want a cheap realtor. You also don't want to go online and try to find the cheapest interest rate from a loan standpoint. Why? Well, you might go and find a company that, let's say they'll give you 1/4 or 0.5% lower in rate, but they close loans late. What you need to know as a home buyer is when you put in an offer on a house, you're also going to put in that offer gets accepted, you're also going to give a title and escrow company, or if you're in a different state, it could be an attorney. You're going to give them what's called earnest money. Earnest money is in good faith that goes towards your down payment and closing costs. That money goes towards your down payment and closing costs, but that's also in good faith that you're going to close the loan on time and you're going to buy this home. Well, a cheap online lender, when you're making such a large financial decision, they can close your loan late and not really give two craps, which really sucks for you because you can lose your earnest money. The sellers can say, hey, you want to get an extension? I gave you 25, 30 days to close on my house. You want to get an extension? I don't want to give you an extension. I'm just going to keep your earnest money. And earnest money is typically 1 to 3% of the value of the home. So you want to find a really good company that's reputable, that's able to service you, which is also another really, really big deal. A company that's going to hold on to the servicing of your loan. Now, why is that important? That's important because majority of the time, with rates being higher today, you will refinance. I personally refinanced on the first home that we bought. I refinanced it twice. The second home that I bought, I refinanced it once. You're probably going to refinance. A refinance simply means changing terms of the loan to fit you best, like whether it's lowering the interest rate or lowering the term from like a 30-year to a 20 or a 15, whatever the case might be, right? Things change. Maybe you want to pull some money out of your house once it appreciated by 100, 200, 300K. You want to make sure you have a company that's able to service, because those refinances usually are at no cost as if they're servicing your loan. A refinance could be anywhere between $6,000 to $8,000. So you don't want to go and try to save 25 or 30 bucks a month and put such a large earnest money or 1 to 3% of the purchase price of that house in jeopardy simply to save a penny, right? You don't want to lose $1 to save a penny. And having a good broker, having a good mortgage company that services their loans is huge, because then you're able to establish a really good relationship with that lender and also with that real estate agent. Now, the last thing that I want to talk about is the type of home. If you want to buy your first home, super, super, super exciting. And I know that you're going to show the house off to your family, to your friends once you buy it and all that jazz. My number one sole advice, and I'm going to give you this from the bottom of my heart. I want to say, think like an investor when it comes to real estate. Majority of families live in their homes for 5 to 7 years. That's a stat, right? 7 years. It used to be 5, now it's 7. 7 years you'll live in that house, and then you're going to most likely sell and reinvest or convert it into a rental and buy another home, whatever it might be. So my number one goal is, when I look at homes, and what I encourage all my home buyers to look at when they're first-time home buyers especially, is the appreciation of that house. If you're a little bit good with your hands, meaning you're okay doing a small construction jobs, I'm not saying you need to be a full-on contractor, but if you're like, look, I can probably watch some YouTube videos and focus on doing very, very small rehabs, or I have contacts in contracting, go find an older home. Find a home that needs a little bit of love, a little bit of rehab. Because $1 that you put into a home, you're going to get 3 to 5 out. Meaning if I go and I spend $10,000, which is actually a lot on a bathroom remodel, but if, let's say, somebody goes and spend 10 grand, their home most likely appreciated by 30,000 to 50,000, depending on the home, neighborhood, location, and all that jazz. So $1 in is $3 that you put back into your pocket for appreciation. So that's really what I want to encourage everyone, is look for the right house and focusing on your exit strategy on that house. You'll be paying yourself every single month, so you're building equity, and then your home is going to grow in value, so you're going to build that appreciation, and then you could sell that home and buy a new house. Now, as long as you live in there for at least 2 years, you're not going to pay capital gain tax. You'll be good to go, which is a big factor. Anyways, this is a really, really, I want to say, broad overview of buying your very first home, Real Estate 101. But remember, figure out your budget. You don't need 20% down. 3 to 5% down is totally fine. Get pre-approved off of the budget that you're comfortable paying. Find a really, really good real estate agent in your market that knows what they're doing, and then really evaluate the type of home that you're looking for. Because when you go and exit and buy your next home, I can promise you're probably going to sell that home in 7 years. That's a stat. That's the majority of families. The goal is you want to have as much money as possible to buy your next home. Don't look for your dream home. Find a house where you can make money on it and then roll that into your next deal. Maybe do that once, maybe do that twice, and then you'll be able to live in your dream home, dream locations, while keeping your budget the same. Thanks, guys. Take care.